Friends, welcome to another 180 Markets Pro Investor Series. Today, we have a very, very special investment group, Spatium Capital. And I'm really excited to speak with them and their managing directors, Jesse Moores and Nicholas Quinn. And the reason why is because they really combine a combination of fundamentals, quantitative, a true selling strategy that they're going to discuss in detail. Because by the way, selling is the hallmark of all great investors. And enough with me, here to talk all about it. Jesse and Nicholas, welcome to 180 Markets.
Thanks for having us, Greg. Thanks, Greg.
Guys, can we start out with just a little bit, spending some time on your backgrounds? Obviously, people invest in people as much as anything else, especially in an intellectual business like investing. Can you just give us your backgrounds?
Yeah, sure. So I guess for the combined anyway, we've known each other for about 10 years now, a little over 10 years. We got together 7 years ago, starting out on a market neutral strategy, which after quite a bit of research and development to that, we abandoned the short part of that market neutral strategy. We felt that we couldn't really derive an edge. As we know, often short positions can stay liquid or aggressive, or overpriced companies rather can stay overpriced longer sometimes than you can maintain your short position. So we abandoned that approach, but built out quite a robust long only approach to the way we're investing, which we'll touch on throughout this video. So yeah, that was about 7 years ago. Now we launched our trading strategy back in 2018 with a seed investor who's still on board with us today, which is fantastic, and been running the small companies fund ever since.
Yeah, no, there's a saying about that being short sometimes could be a widowmaker, especially trying to short overvalued companies, because if it was overvalued in the first place, there's a very good chance it can get even more overvalued. Can you just talk a little bit more, I guess, about this path? Obviously, I can hear from your market neutral strategy, abandoning the short side, how it got into your current strategy. Maybe if you want to take it even a step further about the genesis of your strategy, but more importantly, what is your exact strategy?
Yeah, so I guess for us, when we sought out to tackle this market neutral approach back in 2013, 2014 now, our approach was to try and quantify, if you like, fear and greed. We were looking for companies that were at the extremes, heavily undervalued and heavily overvalued. As you touched on, Greg, it was quite difficult to, at times, maintain which companies were overvalued or would continue to be overvalued on, I guess, some of the more traditional metrics for longer periods to come. We all have examples of those in our stories. The Teslas of the world and CSLs, and even Afterpay this week was a fantastic example of a company that's continued to just go from strength to strength. To that effect, the greed component, if you like, was very difficult to try and build a robust angle. And again, from some of those fundamental perspectives and financial ratios, you can have quite elevated measures and they can stay at those heights for long periods of time.
Absolutely.
The fear side was actually quite interesting because companies, generally speaking, at the extreme end, have a tendency to not really go below their book value. Not always, but for the most part, there's a lower limit, if you like, to how low a share can go, rather than the overvalued, how high an Afterpay or other can go. So to that effect, our greed research was difficult to nail down and probably took us the best part of a year and a half on some of those greed case studies to get some great working information. The fear side of the book, the other side, the undervalued side, we started to see some very consistent patterns between days 14 and days 30. So for us, a majority of our outperformance comes between day 0 and day 21, the first 3 weeks of taking a position. A minority of our outperformance comes between day 21 and day 45. And after day 45, we actually make very little outperformance. We're back shooting in the breeze with everybody else, if you like, by, I guess, violation of this company, the fear, if you like, dissipating from this price, and it returns to its fair value. It's happened quite consistently over our journey. It's been a fantastic approach for us. We've had the portfolio rotated somewhere in the vicinity of 28 to 30 times now. We're quite confident on the robustness of our approach, although it is very different to your buy and hold managers that want to meet management and hold a company for 3, 4, or 5 years. we look to get in and get out approximately a month later.
Yeah, no, that's really fascinating. And I definitely want to touch on the 14 to 30 day point that you mentioned when we talk more about selling, because as I said, I think that selling is by far and away, friends, the most underrated aspect of investing. I'll say it again. Selling is the most underrated aspect of investing.
I could not agree more.
But starting before you sell, you've obviously got to buy. Can you just tell us a little bit about how do you quantify or form your investment universe in the first place? What is it that you're looking for?
Yeah, so for us, we're an ASX 300 limited fund. So we're looking for companies in the top 300 in Australia. We have a general bias, if you like, to companies in the small ordinaries range. That's the 101 to 300 band. Generally by the basis that the top 100 are actually pretty heavily scrutinized, and there's a lot of banks and analysts and people already looking at those companies. The value, if you like, or the alpha that you are looking for is generally outside that range. So for us, as you touched on already, the selling component is probably the most important part to our business. And we kind of look at it almost back to front of your traditional retail investor, if you like. We like to only enter a position when we know where we want to get out of that position. To that band, the top 300, we're screening, if you like, companies that our target exit price, or what we think is the fair value of that company, the trading price of that company is already exceeding what we think is its fair value, in our opinion. That will knock out approximately 200 to 220 companies from the 300 that we just won't look at any further this week or this month. That will leave us with approximately 60 to 80 companies that are either below the exit price that we think is fair, or even slightly above, but not too far. And that's where we'll start to look at a little bit further. In quantifying and structuring the portfolio, we want to look at companies that have, if you like, the biggest width for their industry or peer set between their target exit price and what it's currently trading at. For example, there's companies that we might be looking to make 2 or 3% for a company. We'll buy in at, say, $20 and we're looking to get out at 21 or 21.50 over the next month. So where our target exit price has those widths, we'll start to take positions on those companies that provide, I guess, the largest opportunity set for the fund.
Right. And then do you, obviously, as you said, you're basically the small end of the big end of town, if you will, is where you're looking. Do you focus on any sectors specifically?
No, it's something that is, if you like, a little bit more naturally developing. So all of our entry requirements and exit requirements are dependent on the industry in which the company operates. So we're doing a lot of peer analysis from time to time, looking at companies on a relative basis to their peer set and buying the companies in each industry, generally speaking, that are the most heavily discounted. And what that does for the fund is provide a very good downside protection. We're buying companies that are already less expensive than their peer set. And when the market does turn, which happens every couple of months or so, a little bit, and every couple of years on a bigger scale, our companies generally have less far to fall. This was evidenced in March 2020. The market, the small ordinaries fell 23%. The ASX 200 fell about 21%, the one on the nightly news. And our fund only fell 11% for the month of March. So it's a really interesting approach to buy companies that, if you like, if you can construct a portfolio that removes the overvalued companies and just retain the undervalued ones, you have a higher propensity for success over the long term.
Yeah, of course. And I love how you're quantitative in your approach. Sounds like you use a lot of Excel screening, if you will, to develop that universe. And what's great is that you're using, frankly, the power of technology to assist your investment process in a big way. Guys, we touched on it already a couple of times, selling. Can you just describe your selling strategy? Because it's not just a price target per se either, is it?
No, it's not a price target. It's we do formulate our entry and exit requirements at the time of purchase. So what percentage you like we're seeking to make on this position. We don't always get that right, and that does regress over time. But what it does for us is have an indicative measure, if you like, of where we're looking to get out. And that exit price is relative, so that floats with the market. So for example, in our earlier case study of $20 and hoping to get out at $21.50 in a month or two. If the market rises 10%, our target exit price will also rise 10% with that, because we're not in control of the macro environment and what happens with the broader markets. We can only control on a stock by stock basis where we'd like to get in and where we'd like to get out. Similarly, the same happens in reverse. During market corrections or times of periods of pullback, if the market's fallen 10%, our target exit price will similarly also fall 10%. And that helps us keep the portfolio turnover consistent. It helps maintain our low cash weighting. We have, generally speaking, less than 1% cash at all times in the book. We are fully invested. And what that did, I guess, for the biggest test of all funds during COVID, we were buying the entire way down and selling the entire way down through the fallout of March. But also we were buying great companies at the bottom on March 23rd that no one knew was the bottom at the time, but we know in hindsight. And we enjoyed a 21% ride up in April when the XSO rose 14%. So we had a great April on the way back up by staying invested and not sitting on the sidelines.
Yeah, no, it's absolutely fascinating. And, I guess as an aside, then to dovetail a little bit, do you run some types of screens or regression analysis to just look for further ways to optimize the portfolio? As you said, maybe it's, days 14 to 21, but the market is a moving beast. Maybe it's changed or something like that. Do you use any type of data science?
It's something that's evolved over the 10 years. Jess and I have been working on this together, and we've had some long late nights discussing this piece. Our biggest priority, I guess, is our investors and prioritizing and us illustrating and demonstrating quantities and qualities that you would want to see in a fund. Our original thesis and the way we worked on this actually arrived at a portfolio that only had 8 to 12 companies in it at any given point. That would be considered a high conviction strategy by most. And it did have slightly higher performance metrics than what we currently have. In seeking to build a long-only fund and a safe product with fantastic downside capture and an equally great upside capture and a lower beta and variance in the market, we were prioritizing some of these risk metrics. So we loosened our entry and exit gates to be slightly wider at that point. And what that did was transform the fund from something that on average held approximately 10 companies to what we have now and have been running a business that has 30 companies on average in its holding period. What that's done is bring down the performance slightly than what we might have expected internally. But the fantastic upside of that has been reduced volatility and increased diversification, which has helped drive up the Sharpe and Sortino ratios of the fund.
Yeah, no, there's no question without, I'd say, I don't know exactly what the number is. When you're having 30 companies as opposed to 10, surely your Sharpe ratio is going to go up. But one point that I did want to ask about is, you started at it from a high conviction fund. So within your current fund, do you have sizing differentials like between, say, like low, medium, high conviction positions, or is it all the same?
No, so we manage an equally weighted book, Greg. That's so I guess part of that rationale is we don't profess to be, as Nick mentioned earlier, the guys that go and meet company management, understand the product thoroughly, know the balance sheet inside and out of these listed companies. That's not our edge.
Right.
So for us to, I guess, walk down the path of falling in love with the company and having a market darling within the portfolio, we think that would actually be a detractive approach to running the book. So our book is entirely equally weighted, so about 3% across each position.
Yeah. And guys, you also said that, you've spent a lot of late nights, it sounds like, discussing the portfolio, and I'm sure too many to count. But from a high level, can you just talk about maybe any learnings that you've had over the journey as far as what has really been the Spatium strength and probably, and on the other side, frankly, lessons to be learned. We all can learn.
For sure. It would be totally remiss to say that there's no weaknesses here, then there is. I guess we'll start with the strengths. The strength for us is a robust, repeatable process. It's a framework approach. We're very consistent in how we do things. We're not two guys sitting here making opinions about companies, meeting managers, or sharing bottles of red wine over dinners with management or board of directors. We want to be distanced from that. We're quite repeatable and robust in our approach and how we do things, and we haven't varied from that approach over the journey. To that effect, it's also allowed us to prove, as we touched earlier on the video, we've had 30 rotations of our approach. It's worked consistently, and we're quite confident on leaning on it. By comparison with some of our peers that might take 2, 3, or 4 years to do a single rotation, that's probably a strength to our expansion of the business. The other side of that coin is the weaknesses that are probably one of the biggest detractors for the fund. And as you've probably already picked up on, Greg, it is a product that is dependent on volatility. We are looking for mispricings. During times of increased volatility, there's going to be increased mispricings. And that is fantastic for the fund. I mean, the March and April period, as much as we've told this case study, was awful personally for all of us. But professionally for the fund was a fantastic period to prove the high volatility nature of the product. During a low volatility environment, the fund will struggle to find as many of these mispriced opportunities, and we would forecast that the outperformance won't be as structured in that time. So that's a key detractor.
Yeah, no, of course. And I would also emphasize for everybody, there's not necessarily always an inherently better strategy or worse strategy. A lot of times it comes down to the execution of that strategy at hand. For sure. I mean, there's some incredible momentum investors out there, incredible value investors, and everything in between. Jesse, Nicholas, any closing remarks for the audience? It's been really eye-opening to hear a truly differentiated approach, as I said, and that was one of the reasons that we were so interested in meeting with you all. But just any closing remarks for the audience?
Yeah, sure. Look, well, I'll go first, but I guess we just like to encourage it. We are slightly different. We really pride ourselves on having a differentiated approach to investing. And as Nick has said a few occasions, we've been able to prove that on multiple occasions now. We're continually looking for mispricings practically every day of the trading week. And if anyone ever wants to have a chat, we're always available to have a coffee. We really love what we do.
Yeah,
great.
I echo that sentiment. I mean, jump on our LinkedIn, jump on the website, sign up for the newsletter. We'd love to get in touch and keep getting the firm's name out there.
Great. Guys, thank you very much. And please stay in touch, and we'll be sure to send you, and I'm sure that there will be questions to follow up on it.
Thanks, Greg.